In today's video, we're going to take a look at KKR Capital Corporation, ticker symbol FSK. This was requested by a handful of people over on our Patreon, and I realized that I've never actually really talked about this company before. FS is currently the second largest publicly traded business development company, so I guess it's strange that I've never done an in-depth look into it since I talk about Ares Capital and Blue Owl Capital, the largest and third largest BDCs respectively, pretty consistently. Another reason I think people have become more interested in this stock is because they've been paying so many special dividends this year, probably more than any company I've come across. So today let's take a closer look at this company and see if it's a solid consideration for high-income investors. KKR Capital Corporation is a business development company specializing in investments in debt securities. They provide customized capital solutions to private middle-market U.S. companies. They're an externally managed BDC that invests primarily in the senior secured debt and to a lesser extent the subordinated debt of private middle-market U.S. companies. FS seeks to purchase interest in loans through secondary market transactions or directly from the target companies of private middle-market investments. They also seek to invest in first-liability senior secured loans, second-liability secured loans, and to a lesser extent subordinated loans or mezzanine loans. The company was founded back in 2007, so they're one of a few BDCs that existed before the financial crisis. FSK currently offers a dividend yield of almost 13%, which is significantly higher than the average BDC. If we look at their dividend distribution history, we can see that they've been doing exceptionally well in our high interest rate environment. Their stock pays quarterly dividends, but judging by its payout history, it almost looks like they pay monthly. That's because their stock has been paying a significant amount of supplemental dividends this year, ranging between 5 and 6 cents per share. They've even already announced some special dividends for next year as well, which is pretty unusual. FSK's quarterly dividend amount changes from quarter to quarter. You can see, for example, in 2022, they declared a dividend of 63 cents in Q1, 68 cents in Q2, 61 cents in Q3, and then 68 cents again in Q4. So it changes pretty consistently, unlike Ares Capital, where once they increase a dividend, they don't decrease it unless something bad were to happen. These supplemental dividends have helped FSK post some really impressive returns this year. Running their stock through a dividend reinvestment calculator, you'll notice that FSK has delivered a total return of over 30% this year, which exceeds the returns of the S&P 500. It's even been a better performer than other BDCs I normally talk about on this channel, including Ares Capital and Main Street Capital. So with so many positives, FSK looks like a really good business development company. But there are some concerns I have regarding how well they've been able to manage their business. Looking at their most recent financial results, we can see things have been going really well for this company. Adjusted net interest income per share is significantly higher than it was a year ago, about 9.5% higher in just 1 year. Their last regular quarterly dividend, without accounting for the special dividend, resulted in a payout ratio of just 80%. This indicates that their normal quarterly dividend is currently safe and there doesn't appear to be any kind of potential for a cut in the foreseeable future. As of last quarter, they currently have investments in 200 companies and their 10 largest investments make up 20% of their portfolio. This BDC has 68% of their portfolio in senior secured loans and approximately 8.4% in equity as of the previous quarter. They have a very high percentage of floating rate loans, which helps explain why they've been able to pay so many of those special dividends. 2.4% of their investments are currently on non-accrual, which means that these companies that are borrowing from FSK are doing so poorly that they're not able to pay interest on their loans. In other words, FSKKR isn't earning any revenue from these loans and they have a higher risk of defaulting. 2.4% is actually right around the industry average, but for comparison, as of last quarter, Ares Capital had a non-accrual rating of just 1.2%, half of what this company is experiencing. Their industry breakdown is also pretty good, as we can see they're pretty well diversified across different sectors. They aren't heavily involved in cyclical sectors like oil, and they don't make investments in highly speculative sectors like blockchain or crypto companies. So with so much good stuff going on, what's there to be concerned about with this company? The long-standing problem for FSKKR has been their track record. If we expand their stock share price performance, we can see FSK is currently down over 50% since they went public back in 2014. They performed modestly well for the first 3 years, but then starting in 2017, things went haywire for the company. From 2017 to the worst of the pandemic, their stock share price fell by over 70%, which is extremely bizarre for a business development company. These stocks are supposed to have much steadier share prices, ideally with a little modest growth over time. If we look at their dividend distribution history, we can see this company was paying 89 cents a quarter back in 2015, but they went through a series of dividend cuts, going down to 76 cents per share and then 60 cents per share. The reason behind these losses is simple. FSK has had a long history of making bad investments. One metric I look at whenever I'm analyzing a BDC is their net asset value. This is also referred to as the book value over on their balance sheet, and it's the most important metric to look at in my opinion for these kind of companies. The NAV represents the total value of all the investments the business development company holds. This number should remain steady or even better, grow over time if possible. Because BDCs are required to pay out 90% of their earnings to shareholders in the form of dividends, this doesn't leave much left over for growth. So it's important that a BDC's NAV doesn't fall too dramatically over time because it can be really hard to recover it. Most BDCs have seen their NAVs fall due to high interest rates, so once rates get cut, then I expect many BDCs to see their NAVs see a slight recovery. But FSK has had a very long history of seeing their NAV erode. Over the last 10 years, this company has seen its book value per share fall pretty consistently, which shows they haven't been making good investments. In just the last 5 years, their NAV has fallen by more than 30%, which is really shocking for such a large company in this sector. Over the last 8 years, FSK has experienced realized losses of nearly $1 billion, which is shockingly bad and one of the worst among all business development companies. For comparison, look at Ares Capital's book value per share. They've been a much better managed BDC that's still seen growth over time. It's not a huge amount of growth, but this is really ideal for BDC since, again, they have to pay out so much in dividends to shareholders. Another great example is Sixth Street Specialty Lending. They've also seen a good amount of growth over time in their book value. The number one demographic that's attracted to BDCs are retirees who are looking to live off dividend income. For those who aren't working anymore, it's important to prioritize capital preservation with your investments. Some investments might not have a great track record with capital preservation, but yet still offer a high dependable dividend. In my opinion, it can still be worth holding some of these types of investments, but it's not a great idea to allocate a ton of money into them. If we look at the total return of FSK since their IPO, it's only provided an average annual return of 4.79% since going public. That comes out to a total return of 57.37% over the course of almost a decade. Keep in mind, this is assuming that you reinvest the dividends. Had you chose not to reinvest the dividends, like let's say you're currently living off the income, it would only give you an average annual return of 2.28%. These are not great results, especially for a BDC where there's plenty of other options to choose from that offer much better returns. I think everybody's speculating what does the future hold for this company, because it's tempting to think that with so many special dividends and their great performance this year, that the company might have gotten their act together. After all, going back to their book value, their NAV per share has remained pretty stable over the past 4 quarters, which is rare for this company. The reason they've been able to pay so many special dividends isn't because they've all of a sudden started making greater investments, it's because of all the floating rate loans that they've issued. When interest rates rise, borrowers of floating rate loans have to pay the lender more money, and in turn many BDCs have been able to pay more special dividends since rates increased. Once interest rates get cut, then many BDCs will stop paying so many special dividends. Even when interest rates were at historic lows, FSK was still making bad investments. So when judging whether this would be a good investment, I think it comes down to what you're looking for. FSK, I think, could be a good short-term play. They continue to post some really good interest income from their investments, and they keep paying these special dividends. But when considering if this stock I think would be a good long-term holding, especially for retirees, I can only judge them based by looking on their track record. I wouldn't personally consider holding this company for myself if I was living solely off dividend income. I hope these good results continue going forward, but I think it's too risky to stake a large sum of money into a group of managers who don't have a great track record. In fact, they have a worse track record than most in their sector. Plus, again, there's just so many better options that exist with stronger track records. Ares Capital, Blue Owl Capital, Capital Southwest, Hercules Capital, and the list goes on and on. It's for these reasons that I just don't have any interest in investing in this company. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.